Hey everyone! Today we're diving into the thrilling and sometimes terrifying world of short selling. The high stakes game of betting that a stock will go down instead of up. Sounds simple, right? Well, buckle up because shorting is not for the faint of heart. In this video, we will discuss in 4 sections. 1. What is shorting and how does it work? Second, legendary short sellers. 3. Hedging and options. 4. Short squeeze. Without further ado, let's dive in. Most people invest in stocks hoping they go up, but short sellers, they root for stocks to crash and burn. Here's how it works. Instead of buying a stock, you borrow shares from a broker and sell them at the current price, hoping you can buy them back later at a lower price and return them, keeping the difference as profit. For instance, you borrow your friend's iPhone 16 and sell it for $500. A month later, a model iPhone 17 comes out, and the price of the iPhone 16 drops to $300. You buy it back for $300, return it to your friend, and keep $200 profit. Genius, right? Basically, short sellers just do whatever the opposite of buyers do and make profits out of the declined value. But what if Apple suddenly stops making iPhone and come out with a complete new product instead? As the last iPhone ever exists, iPhone 16 price skyrockets to $1,000. Now, you're stuck paying up big time to return the phone. That's the danger of short selling. Your losses are potentially unlimited. Well, for most videos, that would be the end of the short selling intro, right? Not here. We've got plenty more to cover, so buckle up. This is just the beginning. If you predict the market is overbought and will go down soon, shorting sounds cool to make profit. But trust me, it's much harder than just buying stocks. Why? 3 reasons. 1. Stocks tend to go up over time due to inflation, growth, etc. So you're always swimming against the tide. 2. Just like borrowing money in any other situation, you pay fees and interest on borrowed shares. 3. Short squeezes can wipe you out. We will discuss this more later. But when shorts do win, they can make insane money. Let's look at a couple of famous cases. Michael Burry versus the 2008 housing market. If you've seen The Big Short, you know this one. Michael Burry realized in 2005 that the US housing market was built on garbage loans. He shorted mortgage-backed securities, and when the bubble popped in 2008, he made over $700 million for his fund. Jim Chanos versus Enron, 2001. Enron was America's darling until Chanos dug deeper and found massive accounting fraud. He shorted the stock at $90 per share, and a few months later, Enron was at $0. The company collapsed, executives went to jail, and Chanos walked away a legend. Not everyone is a legendary short seller, like Michael Burry or Jim Chanos. To avoid unlimited losses, you need to play this strategy smart and calculated. That's why hedge funds use long-short strategies to protect themselves. The idea is simple. If you short a weak company, you hedge by going long on a stronger one. If both stocks move in the same direction, it's a wash. But if the weak stock drops while the strong one rises, you profit from the price difference. Another way to hedge? Short a stock but buy an index fund at the same time. So even if the market rallies, you're still covered. This helps smooth out the risks rather than going all in on a single short bet that could go terribly wrong. This is called a long-short strategy, and another smart approach involves options. Instead of buying puts outright, which can be expensive and risky, you can sell a call and simultaneously buy a higher strike call with a later expiration. This strategy, known as a call spread, helps limit your downside while still giving you potential profits. It works because the long call caps the risk of the short call, So even if the stock surges unexpectedly, you won't be left with an infinite loss scenario. If you're new to shorting, options might actually be a safer way to start, rather than jumping straight into borrowing shares and praying for a crash. They provide a controlled way to bet against a stock without the extreme margin requirements or unlimited risk. However, if you're new to both options and shorting, well, maybe just stick to watching the big short and keep your portfolio out of danger. We've talked about how risky shorting can be, but what's the worst case scenario for a short seller? 2 words: short squeeze. A short squeeze happens when too many investors short a stock, and instead of falling, it skyrockets because of panic buying. Shorts are forced to cover, in other words, buy back the stock, which pushes prices even higher, triggering more short covering. It's a vicious cycle. 2 of the most insane short squeezes in history. The legendary GameStop saga of 2021 is a true David versus Goliath moment on Wall Street. Hedge funds had been shorting GameStop, GME, into the ground, convinced the struggling video game retailer was on its way to bankruptcy. But then came Reddit. A group of retail traders from Wall Street Bets saw what was happening and decided to flip the script. Thousands of individual investors piled in, buying up shares and refusing to sell. The result? A massive short squeeze that plunged hedge funds into absolute chaos and financial agony. GME's stock price exploded from around $20 to an eye-watering $483 at its peak. Billion-dollar hedge funds bled money, margin calls were triggered, and Wall Street suddenly had a new boogeyman, the retail trader with diamond hands. Some made fortunes, others lost everything. And in the end, GameStop became the ultimate meme stock, an epic financial history. What's the takeaway, you ask? Simple. Never underestimate the strength in unity. GME might be epic, but the biggest short squeeze nightmare happened in 2008 with Volkswagen VW due to a battle for control. At the time, Porsche was secretly increasing its stake in VW, aiming for a takeover. Hedge funds were betting against VW, thinking its stock was overvalued. But Porsche revealed it had control over 74% of VW shares, including options, since 20% of VW shares were controlled by the German government, and index funds in general holding 3 to 5% VW for long term, leaving only a tiny fraction of shares available for trading on the market. Hedge funds borrowed roughly 13 to 15% of VW shares at the time. Apparently, they wouldn't be able to buy back and return stocks without a nasty fight. They were in completely panicking mode. So, with short sellers desperate to cover their positions and almost no stock left to buy, VW's share price exploded from around €200 to over €1,000 in just 2 days. At one point, Volkswagen became the most valuable company in the world. This squeeze caused billions in losses for hedge funds and remains one of the most brutal short squeezes in history, triggered by a fierce corporate takeover battle. The winner of this event, Porsche, people called it a hedge fund that happens to make cars. Lesson learned? When too many people bet against the same stock, it can blow up in their faces. Big time. Short selling isn't for the average investor. It's risky, costly, and if things go south, you can lose more than you originally invested, unlike simply buying stocks. While it plays a crucial role in exposing weak companies, timing is everything. One wrong move and you could get crushed. Most investors love a rising market and feel the pain when it crashes. But short sellers? They profit off others' misery, making this strategy not just unpopular, but often downright hated. There's also a moral dilemma. Betting against companies can feel predatory. On the flip side, short sellers help uncover fraud, expose companies that cook their books, and pop irrational market bubbles. Like it or not, short selling has both a dark and necessary role in the market. Have you ever tried short selling? If so, how did it go? Do you think shorting is too risky or a necessary part of the market? Were you watching the GameStop madness in 2021? Did you make money or just enjoy the chaos? Let me know in the comments. If you enjoyed this, don't forget to like, subscribe, and hit that bell so you don't miss the next deep dive into the world of finance. See you in the next one.